Hello and welcome to another episode of Angel Inside. I'm your host, Tom Britton, co-founder of SyndicateRoom, and on today's episode, we're looking at the changing face in global venture capital with Colin van Ostern, the incoming head of the UK and EMEA for Alumni Ventures. Colin's going to talk us through some of the green shoots he's seeing and how the next generation of category-defining companies is increasingly likely to emerge outside of Silicon Valley. That's why Alumni Ventures, one of the world's most active venture capital firms with over 1,400 portfolio companies, is so bullish on the UK's ecosystem. Let's welcome Colin to the show. Colin, it's a pleasure to have you on the show. Thank you for joining us today. Before we dive into Alumni Ventures, I'd love to hear about your journey from studying international relations to becoming an operator to eventually finding your way into VC. How did that all come about?
I moved around a lot when I was a kid in the US and a little bit in Canada. Went to college in Washington, D.C., moved to New Hampshire, which is north of Boston, for my first job out of college, and worked in politics for about 4 or 5 years very early in my career. I met my wife, Kristen. We started dating, and I ended up following her to business school at Dartmouth College in New Hampshire. That is where I met a co-founder, started working on a venture together, and have been pretty active in the space since in a few different ways.
Cool. You seem to have always had this interest in politics, of course, and your startup was based on voting, if I'm not mistaken. Where did the idea for that business come from and how did it play out?
I would say politically adjacent, maybe. It wasn't about voting in elections, but the startup we worked on, which was ultimately this was back in maybe 2006, 2007, was called Open Vote. A friend of mine and I were talking over beers as he was a student and I was a partner in business school. At the time, just the year before us, students had gotten involved in a big cheating scandal. Everyone was talking about it, but no one knew what everyone else thought, meaning like people didn't know, should they get kicked out? Should they not? What are the subtleties of it? We were talking about it's odd that in a given community, there's not a way to ask other people what they think. We started Open Vote as a way for any given community, whether it's a college campus or a workplace or business school, for people to be able to pose questions to the rest of the community and have a verifiable way to understand what other people are thinking, more than just gossip and rumor. It was a fun project. We worked on it. We were excited by it, ultimately not successful, though we brought it to a handful of college campuses, brought in tens of thousands of users to the site, and learned a lot in the process.
And I see the entrepreneurship bug didn't really leave you because in your next role, while you were more in brand and marketing for a firm, you were quite entrepreneurial. You helped launch a new college. And that college, I think it has quite a good story behind it. So if you don't mind taking us through that and what you were trying to achieve with that.
Yeah, so this is actually directly connected to the way I think about venture investing. I had a really extraordinary opportunity. I worked at a school that's probably not well known here. And at the time, it wasn't well known in the States either. It was called Southern New Hampshire University. One of the gentlemen on our board was Clay Christensen, famous HBS professor, author of The Innovator's Dilemma.
Competing against luck.
And he has kind of a very specific, disciplined way about thinking about disruptive innovation, a term that is far too commonly used and to often just mean neat new stuff. But it really isn't that. It really is about bringing non-consumers and low consumers into a market that could be well suited for them, but often the products in that market were kind of built for legacy players or built for past incumbents. And so it's often the products are not really built for these non-consumers or low consumers. And it's usually not about tech, but tech often enables the way of doing this. What I worked on was building a new nonprofit online college using what's called a competency-based model, effectively personalized learning where students can move faster or slower depending on what they already know or can do. And it was the first in the United States to be authorized for federal student financial aid this way. It was a huge source of innovation and growth for the college. I learned a tremendous amount. And that lesson of really being laser focused on who your customers are, what job they are hiring you to do, that jobs to be done framework, is a lot of the way that I have thought about a lot of other ventures since, and about venture capital investing too. I joined Alumni Ventures in 2019. At the time, it was kind of starting to grow very fast, but relatively small in the world of venture capital. Our founder and CEO, Mike Collins, had a really big, bold vision for it. And he basically started the company because he was unhappy with the quality of deal flow he was seeing as an angel investor. That really is what was bothering him. And it was the first time the company was hiring for a COO role, a chief operating officer. I was a somewhat unusual fit for it, to be honest. When I sat down with Mike, I shared the story of what we had done at Southern New Hampshire University, how we built a college for, in our case, 41-year-old woman with kids who couldn't afford college after high school, and we needed to rebuild the entire product for her, and it worked. And he said, both, that is exactly what I'm trying to do with venture capital and essentially democratizing an asset class that was built for other people. It was built for multi-billion-dollar family offices and pension funds and endowments, but really could benefit a lot more people by being able to access it. I didn't know it at the time, but true story. 6 months after I took the job, I was reading one of Clay Christensen's books right after he passed away called How Do You Measure Your Life?
That's a good one.
a great book. Has a couple basic lessons, and there is a small vignette in that book about Mike Collins, the founder of Alumni Ventures, who had been a toy inventor early in his career, and Clay Christensen wrote about him. Mike had never even brought it up in our interview, but it was fascinating to me to kind of see how these disparate threads that don't seem connected can actually be pretty well connected.
I recommend that book to a lot of people. Also, thanks for sharing this story. I'm curious though, after setting up the college, what was it that made you want to seek out the role working for the venture fund?
It really was about the scale of impact and innovation that Alumni Ventures was aiming for at the time. I am much more of an operator than I am an investor. And that's true of my job, what my job has been at Alumni Ventures in the past. Often it's been kind of managing the operations of the company. While I've had the really unique privilege to hire many of our investors and many of our partners and to kind of work closely with them, I'm generally not the one who's in meetings saying, yes, we should invest in this and not in that. And I've really enjoyed that process because in many ways, Alumni Ventures has been a startup itself too, and has really kept that startup ethos. We ship quickly, we iterate, we push ourselves to be innovative. We really try to stay focused on who our customers are. And when I say customers, uniquely as some companies do, we really have two sets. One is the startups that are effectively buying money from us with equity, and the founders and what they're doing. And so we have to think about them as a really central customer, really central constituent. What do they need? What job are they hiring us to do? And then separately, in the US, the generally kind of mass affluent or high net worth individual investors, Alumni Ventures has about 11,000 investors who've invested in its funds, primarily in the US. Staying focused on those things has been really interesting to me.
You mentioned it before, but one of the reasons for setting up Alumni was Mike's interest in finding better deal flow or getting access to better deal flow. Alumni's grown a bit since being a way of angel investing on a bigger scale to being a firm that manages several billion in assets. For those that this side of the pond who are less familiar with Alumni Ventures, can you give me kind of a top-down look at what it is you do and how you do it?
So Alumni Ventures is a US-based venture capital firm, manages north of $1 billion, I think about $1.5 billion right now. It's about 10 years old, I think 11 years old now. And to date has been 90% based in the US. In the past year or two has been named one of the top 20 venture investors in North America by Time Magazine and by CB Insights. And it really is a unique investing model in two ways. So everything about the company is based on a thesis that network-powered investing can bring better access, deal flow, and support for portfolio companies than just individuals with kind of rock star Rolodexes on their own. And so that theory is how Mike started the company, is how it has been built over the course of the past decade. The two things that make it very unique in the US are, one, most of the investing capital that has been raised in the US is from high net worth individual investors. So it's often folks who have put in $50 or $100 or $250,000 into funds. That's very different than traditional venture capital in the US, where it's often, folks who are writing $100 million or $500 million checks into funds. The other side of what's unique is that Alumni Ventures has exclusively been a dedicated professional co-investor. Never leads rounds, never takes board seats. That's very purposeful and deliberate because we work to build a large portfolio. So we have north of 1,400 active portfolio companies. And that's a network too. Those founders often are a great source of deal referral. Often folks exit one company and go on to found others, or their executive team does the same. And so we really work to kind of build a network of investors, a network of portfolio companies, and use that scale to access great deal flow that Mike never would have been able to get on his own. And most individuals can't, even very connected, powerful ones. And then also it gives us some breadth to be able to help portfolio companies at a broader scale as well.
Looking at the way that you've approached things so far, I think you said 1,400 companies.
Yeah.
You're not, I presume you don't have any sector focuses with the fund. Do you view it as a positive to be agnostic, or do you think there are some downsides to it?
I would say that firm is sector agnostic, but we manage funds that are not. Now that the company has grown significantly, we have 40 full-time investing professionals in the United States, starting to set up a new office here in London right now, and one in Tokyo as well this winter. And we really strive across our investing professionals to think of how to hire and develop teammates who are T-shaped, meaning have sufficient generalist scale to be able to see deals that can be referred from our network or otherwise. But typically, most of our investors have at least one area where they have deep personal expertise. One of our managing partners in Chicago, named Mike Perry, manages a lot of our strategies around health tech. And Mike worked previously as a lead director of investments at CVS venture arm in the US. CVS is one of the larger healthcare companies in the United States. And so he has really, and before that worked at a fund dedicated around areas like insurtech, fintech, digital therapeutics. And so he really has a ability to go deep and also talk on a peer-to-peer level with sector specialists within health tech specific funds. The reason as a firm that we believe it's important to be T-shaped, it goes back to what I said a few minutes ago about being laser focused on who our investors are, people who have invested in alumni venture funds. We want to make sure that they have the opportunity to access diversified venture funds. And the truth is, even the smartest venture investors tend to be wrong a lot. There's risk in the asset class. And we work really hard to not be market timers. We were investing in AI when it wasn't cool or sexy. We are still investing in blockchain infrastructure today when it's a little less cool and sexy than it was 3 years ago. And so we're really thoughtful about making sure the firm is not just responsive to whatever a particular trend is at the time, but we do want to have investing experts who understand those trends as well.
Coming on to the topic of diversification, you mentioned having multiple funds. Are each of the funds quite diversified in terms of portfolio size? So you're looking at, 10, 20, 30, 40, 50 investments per fund, or is it pretty narrow funds, but lots of funds across different sectors, themes, stages?
So it depends a little bit from one strategy to the next. We don't have any funds active in the UK in terms of accepting capital. We don't accept capital from UK residents today. We're thoughtful about building an office here first to kind of listen and learn about the ecosystem, support portfolio companies how we can, and go through the appropriate compliance and regulatory process. In terms of what's offered in the United States, most of the funds that are offered are diversified funds. So typically 20 to 25 portfolio companies. From time to time in the past, Alumni Ventures has offered stage-specific funds, like a seed fund, for example. Other than that, though, we make a point of really having most of our funds be diversified to reflect what we see as the very best of the asset class, meaning the geography, the lead managers of the investments that we make, the stage, and the sector. All four of those factors we work to ensure that their diversification roughly reflects that of top quartile venture capital investing. So as a result, we do more deals in California, probably Northern California specifically, than any other geography. We have an office in Menlo Park. It's not our largest office, but we want to ensure that the investing that we do reflects what we're seeing as the best of global venture capital overall. That's one of the reasons we're setting up an office in London, frankly, because even though 90% of our work to date has been in the US, we have strong conviction that in the future, we're in a multipolar world. There are great companies being built in London and Europe, and we want to have as strong of a network outside of the US as we have built within the US.
Of course, you've set up a nice transition into your London office.
Sure.
And you set up the office to listen before you start to properly build out. I'm curious, what are some of the differences between how UK firms or European firms are approaching VC versus in the US?
I'll say broadly within the conversations that we've had within Europe, I think there probably are more venture capital investors here that operate from kind of a philosophy and investment thesis that I think of more like small private equity than I do traditional uh, venture capital. What I mean by that is I've heard more people use the word de-risk around their venture investments here than I have in the US. I think often the investing style in the US is focused more on the power law and potential for asymmetric outlier performance and accepts the reality that there will be investments that are made that are not successful. And that, in fact, if you're not doing that, you're probably not aiming high enough or taking big enough, bold enough, crazy enough bets. I don't want to paint with a broad brush because I think there's a wide range of mindsets in terms of venture investors here. But I do think on balance, I've probably heard more of that kind of de-risking conversation or folks who are really focused on how to ensure a broader set of their portfolio can drive positive results as opposed to trying to think about how big, bold, and ambitious the mandate can be for some of the investments that they make.
Do you think that you'll be adjusting AV's approach at all on how you invest in the UK and beyond market, or will you be pretty much keeping to what you're doing in the US?
Short answer is we're going to keep doing what we're doing in terms of how we make an investment decision. That's different than how we access a deal or how we build relationships with the founder or how we even help those founders. But in terms of whether or not the partner who's managing a deal with Alumni Ventures makes a recommendation to invest in it or not, that's not going to change at all. It's been very successful for us. We're proud of our returns, proud of the track record that we built, probably now one of the top 5 or 6 most active venture capital firms in the world in terms of number of investments that we've made in recent years. And so every deal that we do, we use a scorecard that, that scorecard isn't going to change market by market. What we want is to have the very best London deals, the very best British deals, the very best European deals compete with the very best San Francisco deals, the very best New York deals, the very best American deals. And we invested in Poly AI, for example, a recent large growth round, Cambridge spin out, London-based company. I think it was their Series D this past fall that we made a modest investment in alongside NVIDIA and Khosla and others. That is a good example of a company that can compete with any other company in the world in terms of their valuation, their ambition, their track record, their ARR, their team. So we're going to view investments through the same lens. But what we want to do is increase our surface area, see more opportunities here, build relationships with more founders. There's extraordinary work here. And I think, generally we're bullish both on London in terms of what's happening here, but also on London as a gateway to a broader region where there are the Spotifys and Lovables and Helsings of the world that are being built here in Europe alongside, Revolut and other extraordinary companies right here in the UK.
I'm curious to see or hear your take on Brexit. I know it was quite some time ago, but obviously you're looking at London still as this gateway into Europe, EMEA, and you've set up here in London. Have you found that there are restrictions as a result of Brexit, or are they just water in the bridge? You don't need to worry about them, and access to Europe can be had from anywhere, either UK or not.
I think our lives would be a lot easier and simpler, meaning folks who want to both raise and invest money in exciting breakout startup companies. It would be far simpler if there was one regulatory jurisdiction to focus on in the region rather than multiple ones. There's no question about that. A lot of the work that we're doing, we're making sure that we go through an appropriate compliance and regulatory hosting process that's specific to the UK. And then as we turn our eyes to other regulatory jurisdictions within the region, we'll need to do that same work in other areas. In the United States of America, generally, you're able to kind of do that once, and most of the state-by-state specifics are relatively the same, and you don't need to do it separately. And that's a big benefit, frankly, for economic development within the U.S. because otherwise you would have folks who would only focus on maybe 2 states and kind of ignore others. So I can't speak to all the geopolitics of it, but I can just say for my day job, it would have been a lot easier if things were all under one jurisdiction.
Focusing in on London, though.
Yeah.
You've gone to London, which sits outside of the EU.
Mhm.
What was it about London specifically, instead of, say, going to Berlin and Germany, where there are also quite thriving tech hubs?
Yeah. So, I mean, first of all, we're spending time there too. That's not where we've set up an office, but my colleague, Drew Wanzelak, who is doing a lot of our investing work in Europe, he was at Slush in Helsinki a few months ago. He was at the Defense Summit in Paris the week before that. I was at Super Ventures in Berlin. And so I do think just being geographically proximate does help a lot. The choice of London wasn't particularly difficult for us, to be honest. We already had several dozen folks who had invested in our funds previously who live in London now. Part of that is just the geographic and cultural proximity between the UK and the US. And so it's natural that folks who studied at Yale in the United States and now live in London, and then we have dinner in June and they come and meet us. It makes for kind of a more welcoming setting when you already have folks here. We looked at where we have deployed capital previously, and neither London nor the UK are a majority of the capital that we've deployed in Europe over the last 10 years, but it is a plurality. We've deployed maybe $60 million into Europe, maybe 20 of that is in greater London. So it is kind of a natural center of gravity for us. And then I'd say the final point is the broader region, meeting with folks from South Africa or from the United Arab Emirates or other regions, just as often they are in London as we are traveling elsewhere. And I do think in many ways, London still benefits from being a gateway to the rest of the world. And so for setting up a physical office, that's a convenient way to be proximate to a lot of people who are coming in. I'm meeting with somebody who was in Turkey when I talked to her yesterday, and she's in London for meetings this week. That's fairly common.
It's a wonderful international city. Obviously, we're based in the UK as well. I don't want to come across as pessimistic about London. I was just curious as to your thinking.
Everyone complains about the weather in Britain, and it's actually been lovely since I've been here. I think there's often a kind of self-deprecating or self-effacing way that people express themselves here. And sometimes that comes through on the economy or, kind of where London sits in its growth moment right now. What we're seeing in quantum computing, for example, is extraordinary. The investments, particularly in places like Oxford and Cambridge, are extraordinary. Literally some of the best hubs of innovation on planet Earth are a very short train ride from here. And we've seen extraordinary companies like Revolut, I mentioned earlier, or others that are Poly AI, for example, based here in London. I mean, there are companies here to be proud of that can compete with the very best companies anywhere in the world. And so what we want to do is find ways to support them, find ways to help more companies become them. Because of our breadth, I think we have a unique position to be a little bit of a bridge across the Atlantic in both directions, where we can bring some of the best Silicon Valley style global deals to folks outside of the US, but also help portfolio companies on either side of the Atlantic access markets as well.
I love the bullishness. Obviously, in the wider market, there's been a lot of discussion around how little capital is flowing in right now. It seems to me, and I'd love to get your take on it, that there's a very polarized market. You talked very early on about wanting to get good angel deals and access to that, but the capital flowing in at seed and at angel level seems to have hopefully hit the bottom. But then you look at the other side of it, and these massive funds raising, Andreessen Horowitz have just raised $15 billion. It's like two complete ends of the market. What are you seeing?
We have been very deliberate at Alumni Ventures to build a strategy around that. For those who study venture investing, they'll tell you that the returns basically come from two places. One is the power law, asymmetric returns from some outliers that pay for far more losses. And two is being able to double down on your winners. We've built a model that allows us to place a lot of bets, so be able to engage in true power law investing. But when we see traction, to be able to deploy not $250,000, but $1 million or $5 or $10 or $15 million into that same company, so that as they start to grow, we can help our investors really kind of take advantage of that growth.
One more question related to the broader market, because we talked about this kind of, where I brought up the polarity and seeing huge funds being raised and small funds being raised. Are there other drivers or other trends that you're seeing from 2025 came through to 2026 that are giving you this optimism that you have?
I'll say, I think for the industry, 2025 was a pretty rough year from a capital raising standpoint. It's been nice that we've been a little bit countercyclical in that regard. We had a stronger fundraising year in 2025 than we did in several of the previous years.
Do you think that's because the audience that you raise from are non-traditional LPs? I know you have some larger traditional LPs.
Yeah, I think it's probably a mix. I think we also had some nice liquidity, and when you have positive exits, that tends to have a compounding effect, right? So I think we liquidated a position in Rigetti Computer, which is an American company, but a pretty substantial operation here in the UK, actually. They had gone public. We were an early investor. That was an early year exit. One of our portfolio companies IPO'd Circle, which is a stablecoin company based in the US. And so obviously some of that does help give a boost to fundraising. I also think there's just a network effect as you build more portfolio companies and individuals who are engaged in the network that it, can kind of be supportive. But I would say we're still kind of processing it, but there was a flurry of acquisition activity over the holidays. We were a multi-round investor in Grok, not Grok with a K for the record, Grok with a Q. The better Grok is the way I think about it personally.
The more politically correct Grok.
Yeah. The inference chip company, effectively, NVIDIA acquired their business. This is a somewhat non-traditional acquisition. They're still kind of working through all the details of that. Observe has announced an acquisition by Snowflake. And so I guess my point is, I think that we'll probably see more liquidity in 2026 than even in previous years. The combination of creativity, acquisitions, seemingly some positive examples from an IPO market. The Circle has had some ups and downs throughout the year, but quite positive IPO on the day of it happened and looking back 9 months later. So I think that there's some positive signs there. And I think that's overdue for a fundamentally illiquid asset class. There has been a lack of liquidity in years. And so having examples like that speak well to the future is, I think, important.
And do you think much of that liquidity is going to get recycled into new funds?
Yeah, I mean, we certainly see that with our investors. As you said, we have a somewhat non-traditional LP base, and that most of our investors in the US have been kind of high net worth individuals. I think we see expansion of the asset class generally, and that more folks are interested in looking at individual deals. People who wouldn't have categorized themselves as angel investors 10 years ago. 10 years ago, being an angel investor in the US at least meant that you go to like a local Holiday Inn or whatever the equivalent of it is, and you sit in a boardroom and you hear some people pitch from the local area about what their deals are. And that really has changed in the last decade. There's increasing professionalization, democratization, access, increased deal quality generally, though we think it's still pretty varied, to be candid. I think more people who only would have invested in a fund 10 years ago are open to looking at individual deals sometimes now. Many people have pointed this out, but we're seeing this extraordinary lengthening of the venture life cycle. Companies are staying private much, much longer. We actually spun out a company on January 1st of this year specifically to focus on secondaries and growth stage venture, because we're seeing these companies that are multi-billion-dollar companies that have no intention of going public anytime soon. You look at in the US, the top 10 market cap companies in the United States of America, 7 of them were venture-backed in their infancy. To ensure that as our economy moves forward, there are ways that people can kind of access those pre-public equity companies. It's getting a little more complicated to do that as companies stay private longer.
Definitely. There's a whole government commission here looking at secondary markets and how to deliver that liquidity to try and effectively bring more pension funds into the UK startup ecosystem. You look at the US market and you have all these endowment funds and other LPs putting money in, and here very few, and the government really wants to tap into that.
And I know there's been some work in that regard. I attended a briefing at the London Stock Exchange this fall about Pisces, the model that they're building to do some of this work. Look, I think it's important to be looking at new ways to do it. Companies innovate, and so it's important that markets innovate to follow them.
Definitely. Well, look, you've been absolutely fantastic. I like to end every show with a few rapid fire questions. The first question I'm going to ask, what's the most interesting book that you've read recently?
I'm going to give you 2. I reread 1984 after I moved here. There's a bar that I can see from my office window that has a little plaque that says George Orwell used to drink there. And I suspect that there are 30 other pubs in London that have that same plaque.
Probably.
But it still was fun to kind of read it and think through London from an oddly dystopian, historical, futuristic perspective. Love that book. I think I've reread it 50 times since I first did when I was 13 or 14 years old. On a more serious note, though, this summer I was going to go to Vienna and then had a trip sidelined, but I picked up and started reading a book called The World of Yesterday by Stefan Zweig. And it's just fascinating. It's somebody's memoir who was born in the Hungarian Empire in the 1880s and died after fleeing Germany in 1945. He died in Brazil. And it is just so poignant and painful and emotional, but you also kind of realize there are these lifetimes in which history changes so much. And I think the one that was a particularly painful lifetime, but over the last 100 years, we've had both so much change and innovation and so much pain and human suffering at the same time. And it just was fascinating to read that and to think about what we're in the midst of right now.
Next question. If you were in VC, what do you think you'd be doing?
Well, one would think, looking at me from the outside, that I would say something about politics or government because I've served in public office. I served 2 terms in the US in office, ran for office for other offices. But right now, most of my time I focus on when I'm not at work, my 12-year-old and 15-year-old. So honestly, I think if I wasn't doing this, I would be a stay-at-home dad. Those are awesome ages, and I know they're going to be gone very, very soon.
For anyone looking to get started investing in startups in 2026, what's the best piece of advice that you would give them?
So I never give personal investing advice because we all have our own philosophies, but I will say, know your place in the ecosystem. Know, are you making an asset class diversification play? Are you investing to learn? Are you investing because you have an edge and you see something that others don't? And try to approach it from a place of humility.
So what are you most looking forward to in that role?
I think it's exciting to meet new people. I think that we are living through an unprecedented amount of technological and social change right now. And so I'm extraordinarily lucky to be able to put myself in a new physical place, in a new community, meet new people, hear about startups tackling problems from a slightly different perspective. I just think that newness is, if you're not seeing that newness yourself, then you're not challenging yourself enough.
Fantastic. And lastly, for anyone who wants to follow you, where should they go?
So I would encourage people to keep in touch with our new office and new team here. alumniventures.co.uk is the Alumni Ventures UK homepage. You can sign up to get email updates. You can follow me personally on LinkedIn. I try to keep people up to date on some of the work. I'm at Colin Van Ostern. And I'd look forward to meeting people in person too.
Honestly, thank you very much. Anyone who can reference both the power law and jobs to be done gets an immediate A+ in my books.
I think that's a decent Venn diagram, but I'm glad that you're passionate about both.
No, fantastic. Thank you so much for joining us today. I would love to revisit this in 12 months' time once you've got fully settled into the role. So I'm going to put it in the calendar, and thanks for taking the time out of your day to share your insights with us.
Happy to do it. Thanks for having me on.
Well, that's it for this episode of Angel Insights. A huge thank you to Colin for joining us and sharing his perspective on why the UK is such a critical hub of innovation for global firms like Alumni Ventures. If you enjoyed this episode, please do like and subscribe and leave us a review. You can find the full show notes and more information on SyndicateRoom.com. Until the next episode, I hope you have a lovely rest of your day. Bye.